Hello, my name is David Schlossberg and I'm the founder and senior partner at Tax Plan for Wealth. Over the years of being involved in financial services, dating back to 1980, I've discovered that the greatest risk to retirement success is income taxes during retirement. I've discovered that the plans we made up build up our 401ks during our working years. They'll firmly work to our detriment when we start retiring and also collecting Social Security. Please watch our other video resources that we put together that discusses the double taxation we face in retirement and how devastating that can be. But in this video, let me put some light on the significance of tax erosion to a family and demonstrate it. Most of us are not even aware of just how devastating income taxes can be to our family's wealth. Many of you might be surprised that if we took $1 and we doubled that dollar every day for just 1 month, 30 days of doubling, we'd have over $1 billion. I know it sounds hard to believe, but it's true. And we have a simple Excel spreadsheet in our office that we use to demonstrate that. I encourage you to try it at home as well. If we start with 1, which then becomes 2, and then becomes 4, after that 8 and 16 and so on, 4 doubles becomes 16. If you try it at home though, you'll find by the 30th double, it's over $1 billion. Now, if we took that same dollar that we doubled, and at the end of each doubling period, we had to pay federal taxes and perhaps state taxes at a combined rate of 28% at the end of each doubling period, for 30 days, if we double for 30 days, what grew to $1 billion net of 28% tax would now shrink to less than $12 million. Does that mean that we've lost $988 million to taxes? No, actually, the cumulative taxes paid would be less than $8 million. The other $980 million is lost opportunity. You see, when we pay taxes on our earnings, we have less left to double. And of course, that lost opportunity will continue for all 30 days during the doubling period. So when that first dollar doubles and we pay the tax, instead of $2, we now have $1.72. And the 28 cents that we paid in tax is no longer available in our account to double on a compounded basis. Having lost the opportunity for the tax portion to double, that's caused the remaining $980 million of wealth to disappear. The tax being paid each year in our taxable investment accounts or trust accounts, that illustration is our taxable accounts. It's those accounts where we get a consolidated 1099 from our investment firm each year, or those dividends and capital gains that transfer onto our tax return, or interest from banks or CDs, or rental real estate income. You get the idea. The tax not being paid, well, that's a Roth IRA. Both of these two types of accounts, they're funded with after-tax dollars. These are monies that we received and taxes have been paid, such as our net wages from employment, or Roth IRA contributions that are funded from those taxable accounts that we mentioned, or IRA conversions where the income tax is paid on the source of funds when the conversion occurs. But those accounts, if held properly, would not experience a tax again, not Roth IRAs, not on the principal deposit, as it's already been taxed, but also never on the growth that occurs. Never. Not even when distributed. And Roth IRAs don't have forced distributions like regular IRAs do. Those forced distributions being more widely known as RMDs, an acronym for required minimum distributions. The dollar doubled for 30 doubling periods is rather dramatic. But even much less doubling periods has a dramatic effect on wealth as well. If in your lifetime you've averaged an 8% return on investments, your wealth without any additional contributions would double in a 9-year period of time. An 8% return, by the way, it's exactly what a balanced portfolio averaged over the past decade. That's a portfolio of 60% stocks, 40% bonds or fixed income. During the same decade, the S&P 500 actually grew by 13%. At 13%, money doubles in 5.5 years. If you take the rate of return and divide it into 72, that tells you how long it takes for money to double. Many of the folks that I talk to and meet with have enough wealth for their lifetime. And they'll also have funds remaining to pass on to the next generation, and perhaps even a third. It's not unusual for many of those folks to believe that their funds will last perhaps 30 years or so remaining in their lifetime, and that the remaining funds to the next generations might very well last another 60 years or so for their kids and their grandkids. Well, at an 8% rate of return, money lasting 90 years will have doubled 10 times. If we go back to our chart and look at the value of a dollar doubled in taxable accounts after 10 doubling periods, it's $226 using a 28% tax rate. While a dollar doubled in the tax-free accounts, or Roth accounts, is worth $1,024. Actually, if it takes 9 years for our money to double, unfortunately we can't wait to the end of the 9 years to pay the income tax on the taxable account. We have to pay the tax each and every year as we go. So if I actually took the same chart and applied the 28% tax each and every year over a 9-year growth period, the $226 would now shrink to $154. So I now would like to pose this rhetorical question to you. Given this information, for every dollar you have in an investment account, would you rather it benefit you and your family over the next 90 years to an equivalent of $1,024, whether it be saved or consumed, or would you rather it benefit you and your family to an equivalent of $154? While this example may seem extreme, it raises the question, should a portion of your investments be protected from taxation? At Tax Plan for Wealth, as experienced financial advisors that are also credentialed by the IRS and taxation, we believe that it's important to go beyond investment management when it comes to comprehensive wealth management. Please feel free to contact us for an initial consultation. We'd be glad to provide you with some further insight into how taxes can be impacting your family. Thank you for joining me today.